Welcome back to The Explainer. Okay, so have you ever noticed this genuinely fascinating mystery in modern global capital? Because if you look closely at the world's largest corporations, and I mean whether we're talking about big tech, banks, airlines, healthcare, or even the consumer goods in your pantry, you start to notice a really distinct pattern. The exact same names and logos pop up among their largest shareholders just over and over again. So today, we are going to figure out exactly why the same few investment firms seem to be behind literally every major industry on the planet. Let's dive in.
Right off the bat, it's a shocking premise. I mean, at first glance, it feels almost like a movie plot, right? Like there's some shadow board of directors quietly running the world from a hollowed out volcano somewhere. But the reality? The reality is actually much more fascinating than most people imagine. Because it's not about a hidden monopoly at all. It's entirely about the unique structure of modern investing and how global capital actually flows from point A to point B.
To really wrap our heads around this, we first have to understand the staggering scale we're dealing with here. We are talking about over $100 trillion in global stock market capitalization. Just let that sink in. This is an absolute ocean of wealth. It represents the combined value of the world's public companies, and it's managed in a very specific, systematic way that quite literally defines our modern economy.
Now, what's truly staggering is how much of that massive pie is managed by just a few giant asset management firms. You've probably heard them referred to as the Big Three: BlackRock, Vanguard, and State Street. Their slice of institutional ownership, especially when you compare it to all other global investors, is incredibly disproportionate. It's huge. But to understand why their slice is just so big, we actually have to rethink what that ownership means in the first place.
Which brings us to Section 1, Ownership versus Control. Let's decode the illusion.
To solve this mystery, we essentially have to rethink the whole concept of ownership. In public markets, what we're actually dealing with is fractional ownership. Think of it like owning a single brick in a massive sports stadium. Sure, that brick represents a financial stake in the success or failure of the business, but it absolutely does not mean you get to call the plays on the field. Fractional ownership is entirely about financial exposure. It is not necessarily about sitting in the CEO's chair and making those daily operational decisions.
So, there is a massive divide here that we need to highlight. On one side, we have fiduciary ownership. This is what those big asset managers do. They hold broad portfolios of shares on paper, and they occasionally vote by proxy. But on the other side, we have operational control. And this is the domain of the CEOs, the founders, and the executive teams, the people who actually manage the daily operations and set the strategic direction. The investment firms hold the shares, yes, but the operational control remains firmly with the company's actual leadership team.
Ultimately, it boils down to this. Owning shares just isn't the same thing as running the company. Just because a massive asset management firm holds a 5 or even 10% stake in a global airline or a major tech giant, that doesn't mean they are actively pulling the strings of the global economy on a day-to-day basis. They aren't in there setting ticket prices, and they certainly aren't designing the next smartphone.
Moving on to Section 2, the Index Fund Revolution, how passive investing changed everything.
Tracing this history is just incredible. Back in the 1970s, Vanguard's founder, Jack Bogle, had this radical yet wonderfully simple idea. He thought, instead of trying to pick individual winning stocks, you should just buy a tiny fraction of every company in the market. And it was genius. Fast forward to the 1990s, and exchange-traded funds, or ETFs, made this whole process even easier. Then the 2000s saw an absolute explosion of this passive investing strategy. Today, trillions of dollars flow automatically into funds tracking things like the S&P 500. And this relentless pursuit of simple, diversified investing is exactly what caused these specific firms to balloon in size so organically over the decades.
Let's look closer at Section 3, the asset management giants, the plumbings of capital.
When you look at the total assets under management held by these few entities, the scale is genuinely mind-boggling. We are looking at tens of trillions of dollars managed by the true heavyweights: BlackRock, Vanguard, State Street, Fidelity. But, and this is a vital piece of context here, this isn't their personal money. BlackRock doesn't sit on a dragon's hoard of trillions of dollars that belongs to its CEO. Not at all. They are managing this immense wealth on behalf of institutional clients.
Which brings us to the absolute bedrock of institutional investing: fiduciary duty. This isn't just a guideline, it is a strict legal obligation. An asset management firm must act entirely in the best financial interests of its clients, period.
They cannot use the funds to further their own corporate interests if it hurts the people who actually provided the money. They are legally bound caretakers. They are not the supreme rulers of the capital they hold.
Okay, let's follow a single dollar step by step to completely demystify this plumbing, because it makes so much sense once you see it. Step 1. A retail investor, maybe it's you, maybe it's me, saves part of their paycheck for retirement. Step 2. That money automatically enters a diversified index fund or ETF. Step 3. The asset manager takes that money and buys fractional shares across the entire market to perfectly match the index. And finally, Step 4. Because the asset manager physically holds those shares on your behalf, they exercise the proxy voting rights at annual shareholder meetings. So you provide the capital and they provide the administration.
The deeper we look into this process, the more we realize this isn't some shadowy monopoly at all. It's actually a massive, incredibly complex web of shared risk and reward. The wealth isn't concentrated because of a few power-hungry billionaires. It's concentrated because millions of regular people are pooling their money into the exact same low-cost funds. It fundamentally shifts our whole understanding of modern wealth. Which naturally leads us to Section 4. Do they control everything? Let's unpack the common ownership debate. When we actually break down the mechanisms of power here, we see a very delicate balance. Asset managers undeniably have influence. They have it through proxy voting and by supporting various shareholder proposals. But, and this is key, this influence is heavily counterbalanced. Corporate boards maintain CEO accountability, and intense regulatory oversight ensures that antitrust laws keep a close eye on market concentration. And honestly, academic researchers are totally split on this dynamic. Some worry that this kind of common ownership reduces competition across industries, while others argue that these index funds are entirely passive and rely completely on independent corporate boards to actually run the businesses. But the consensus view from corporate governance experts is pretty clear. Ownership, influence, and legal control are entirely distinct mechanisms. Evidence from regulators and financial historians consistently remind us that owning 10% of a company does not equate to running it. Having a loud voice in the room is simply not the same thing as holding the steering wheel. And you know, the system isn't static. It never is. Just as the invention of the index fund completely changed the world back in the 1970s, the landscape is constantly evolving today as new technologies and new priorities emerge on a global scale. Looking forward, things are shifting rapidly. Artificial intelligence is completely changing how risk is calculated across the board. Actually, we might even see digital assets and tokenized securities change how shares are physically held and traded in the very near future. We're also seeing major debates around corporate stewardship alongside increased global regulation. Ultimately, we are looking at a brand new frontier of empowered retail investing, which could potentially rewrite these rules of ownership all over again in the coming decades. And finally, Section 5. Who really owns everything? The invisible architects. Behind the massive multi-trillion-dollar numbers managed by the Big Three lies a really surprising reality. When you dig down to the bedrock, the vast, overwhelming majority of this capital actually originates from everyday retail investors, pension funds, insurance companies, and ordinary retirement accounts. The secret owners of the world? They aren't billionaires plotting in a smoky boardroom. The true owners of global capital are millions of everyday people participating in long-term wealth creation. We're talking about teachers relying on their pension funds, doctors, engineers, retirees, and everyday workers dutifully saving a piece of their paycheck for the future. Modern economies entirely depend on these large institutional investors to manage our collective savings securely. Understanding that fundamental difference completely changes how we see the global economy. It turns out the biggest stories in economics are rarely hidden in the shadows. They are sitting right there in plain sight, just waiting for us to understand the mechanics. The world's largest companies are absolutely financially connected, yes, but they are connected through enormous networks of shared investment that ultimately belong to the public. So now that you see past the illusion, now that you know how everyday people are the true invisible architects of this massive system, we have to look forward. Ownership, influence, and control are going to continue to evolve. So the big question is, how do you think our collective investments, your investments, will shape the corporate landscape of the future? It's definitely something to think about until our next explainer.
Thanks for watching World Decoded. Make sure to like and share, subscribe, and stay curious.